This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Jonathan, welcome back to the Human Action Podcast.
Hey, Bob. Thanks for having me.
Sure thing. Well, we are coming off of a great Mises U. You and I had another joint presentation on MMT that the kids liked. And we're back now talking about our favorite topic, money creation. The guest Tucker Carlson recently had was Richard Werner. And I truthfully can say, folks, I have never had so many people requesting that, hey, Bob, you got to take on this interview. Like I want, or, not just like, oh, take this guy down, but also people just genuinely saying, I'm really curious to hear, Murphy, what your response is to this. And I was telling people, well, we're going to be doing a response, and people were anxiously awaiting for it. So, Jonathan, that's where we are now. So just to give context, folks, so Tucker Carlson had Richard Werner on, who is a German-born economist who did a lot of work in Japan. And, if you go watch the Tucker interview, he can give more of his background, and they take 3 hours and go through and really, tells the guy's career and everything. There's a lot there. So why don't we have plenty of clips, folks, and we're going to focus on what's pertinent, I think, to Austrian economics specifically. But before we dive into some of those details, Jonathan, I'm curious, do you want to give your just general reaction to the interview?
Yeah, my general reaction was that, it was fun. It was entertaining. Werner was saying lots of, interesting things, some of them provocative, some things where I was just sort of like, face palming, because like some of the things that he was saying is like, are like these amazing insights that only he has, and that he's discovered these things are things that Austrian economists have been saying for over 100 years. But another general reaction that I had is that he's sort of an ink blot. A lot of people, depending on the school of thought or the sort of ideology that you're coming from, you're able to see some certain things that he was saying and identify with it. But other things that he would say would like totally contradict or go against what you would think. And so he doesn't fit squarely into a school of thought as far as I'm concerned, at least based on the limited exposure that I've had just from his Tucker Carlson interview. I've read some little pieces of his papers and his book, The Princes of the Yen. But like when he's talking about how evil central banking is and how fractional reserve banking originated based on fraud, I was thinking all the Rothbardians are cheering. But then he would turn around and he would talk about how fractional reserve banks ought to limit their loaning, their lending activity to businesses so that they can engage in profitable production and employ people. And I was thinking, somebody like George Selgin, a fractional reserve free banker, is going to be totally on board with that. But then also there's some things in there that MMTers would latch onto, or post-Keynesians. Many of the empirical, modern mainstream economists like the fact that he's doing these tests, actually going to the inside of a bank and seeing how things operate. So really, one other thing I just saw some standard Keynesian stuff in his, at least in the beginning parts of his book, The Princes of the Yen, where he's talking about the problem with Japan is that it had insufficient aggregate demand. But then also it sort of sounds like monetary disequilibrium theory, because he says there wasn't enough money, and the central bank and the banking system always had this opportunity to increase the money supply. So I know I'm throwing a bunch of stuff out there, but my point is that everybody was able to see something that they liked and something that they disliked about this interview. And I think that helps explain why it made such a splash, because there was so much meat on the table for everyone.
Yeah, I think that's exactly right. That you're right. That some people were sharing it out of love, and some were sharing it out of annoyance or incredulity. My quick, just overall reaction to it is, there is a lot in here. Well, let me put it to you this way, Jonathan. I was concerned that my initial gut reaction, because right out of the chute, Tucker introduces him as, and at first I thought he said the most famous economist in the world, and then I re-listened to it. And he said something like one of the world's most famous economists, something like that. I hope this doesn't rub you the wrong way, Jonathan. I checked. You have more Twitter followers than this guy does. And so, no, he cannot be one of the world's most famous economists if that's a true statement. So I'm curious, have you heard of, when you heard Richard Werner is on Tucker, were you like, I want to go see what he's, or did you say, who? Because my honest reaction is I didn't know his name. It didn't ring a bell when I first heard it.
No, I didn't know his name. That doesn't mean a lot. I'm not trying to like put him down or anything, but yeah, I hadn't heard of him before. I think I've heard people refer to Princes of the Yin before.
Yeah. So right, that's exactly. It's kind of like, someone says some name of a famous singer and you're like, what? Who's that? And then it's like, oh, he, and then like, they hum some song that was like big in the 80s. And you're like, oh, that guy? Okay, I just didn't know his name. Similar thing here that, when I first heard that and Tucker's introducing him as the most famous economist or one of the most, I was like, what the heck? And then the more he talked, the Prince of Yen I'd heard. And then the thing too about he's got a paper or like this documentary thing that they did where he went into a bank and worked with them to see what actually literally happens mechanically when the bank gives me a loan. And that was like a big split. And so I've heard plenty of people who don't like the Austrians and say, you guys, rely on this textbook fractional reserve model, and that's been discredited. And so I was like, oh, that's the guy, because they always point to, so-and-so empirically demonstrated, you fools. So anyway, I realized, as it went along that, oh, this is why he's such a big deal, because this is, his thing. And so I remembered a lot of people had pointed to him over the years, but again, it's just to say he's the most famous economist in the world, I literally his name didn't ring a bell. And, people could say that proves how ignorant I am, but, I think I'm fairly well versed in economics. So anyway, the point of that, besides my dumb joke about your Twitter following, Jonathan, by the way, I wasn't kidding. You really do have more Twitter followers than he does. So
well, I saw I think he has 2 accounts. So I don't know if you were.
I checked all the ones I could find, and one of them was a blue check mark. It wasn't like some Stan account. It looked like it was really his account. As far as I could tell, it was blue check mark, and it wasn't. This is a fan account of blah blah blah. So anyway. What I was going with this, though, is to say, because there's so much in there, and the title's very provocative, like the connection between central banking and the CIA and war. So it's all stuff that's red meat, especially since I've been loving Tucker lately for having people like Daryl Cooper on. And so I realized, Jonathan, my initial emotional reaction, and then as you say, when he's going through and claiming originality on stuff that Mises wrote his dissertation on in 1912, I was like, give me a break. But I realized, oh, hang on, I can't just be like the conventional historians who bristle at Tucker introducing Daryl Cooper as America's most honest historian. And when, if Daryl Cooper's main narrative is stuff that the public has never heard before, and it's very important what his claims are. And if you quibble about some nuance he gives to something that happened in 1943, like that's not enough to just throw out the episodes. This guy's a charlatan. So I'm trying not to do that here too, that yes, there's a lot of stuff he says. It was clear Tucker's mind was getting blown by stuff that to you and me, Jonathan's like, well, how do you not know that? This is, didn't Tucker go read Mises' Theory of Money and Credit in the original German? And apparently not. So anyway, that's the point being that, yes, I'm glad that this interview happened. I'm glad Tucker's mind was blown. But one of the main things that happened in this discussion, folks, is that Werner is claiming originality, or at least in modern times, saying that, oh yes, this notion that banks just create money ex nihilo when they make loans, this is something that, they don't want you to know. And we're going to spend a lot of time going through it. And in particular, he dismisses what he called the fractional reserve theory of banks, which everybody would associate with the Austrian school. And so that's what Jonathan and I are going to spend most of our time on here. So a lot of it's going to be us nitpicking and coming off as being very critical. But overall, by all means, go watch the interview. And again, I'm glad it happened. I'm glad Tucker had him on. But a lot of what is going to follow from this, I'm guessing, but also hearing your initial reaction, Jonathan, we're going to be fairly critical. Is there anything you want to add before we dive into the clips?
No, I'll just echo, God bless Tucker Carlson. He's been on a roll recently, having Scott Horton on, Daryl Cooper, all these great guys. He had Ron Paul on a while ago. I would love to see somebody who's like, explicitly representing the Mises Institute there, like somebody like you or Tom Woods or Guido Holzman, Joe Salerno, Tom DiLorenzo. That would be fantastic.
Jonathan Newman, if he wants to get a fresh face, someone who's got a higher Twitter follower than one of the most famous economists in the world, for what that's worth. Okay, so let's dive in. So we're going to play this first clip now for you folks. It'll be fairly self-explanatory. I don't think we need to set this one up, and then Jonathan and I will unpack it.
So the solution to all this and why economics has made no progress is bank credit. Now, bank credit, and actually you should say fully, bank credit creation. This is a concept that's been a taboo or a secret in economics. Banking had been frozen out of economics for a long time. There's no banks in economic models and theories. And that's, of course, also why they don't work. Because in reality, if you ask some ordinary people in the business district of any town, they will tell you, what's important in the economy. They will mention banks.
Yes.
But ask an economist, an academic research economist, and they will not mention banks.
Well, ask any person, who do you owe money to? The bank. Some version of a bank.
Exactly.
Yes.
Well, the reason is that the economists follow this theory that banks are just financial intermediaries. They just, gather deposits here, do their analysis, credit analysis, risk assessment and all that. And then they allocate the funds and invest. Okay.
Right. They just take a percentage. They're a pass-through.
So they're intermediaries.
Yes.
But that's wrong. That's not what they are. It's one theory of banking, and it's still the one that's still dominant. All the textbooks and the leading journals, they still use that. But actually, if you look into it, you realize there's 3 theories of banking. A second theory, slightly older, that was dominant until the 1960s, so-called fractional reserve theory. And you may have heard this fractional reserve banking. What is that? Well, this theory says, and this part is similar, each bank is a financial intermediary. It just collects deposits and then does the analysis, lends out the money. But in aggregate, as banks interact, there's money creation. Oh, and that's where students' ears should have pricked up. Money creation. They even talk about a money multiplier. What? That's the second theory. Now there's a third theory. And that one had been made out to be a wacky conspiracy theory.
Oh.
But it is the one that was more or less quite widely known until about a century ago. And that's the credit creation theory of banking. And this one says banks are not financial intermediaries. Banks are special. They have a unique power that no other player in the economy has. And that is the power to create money. And actually that theory had been called all sorts of names like, this is kooky people and, cranks. Keynes said in his general theory, or it was the treatise on money, these are the cranks who talk about the banks creating money.
I think the average person believes the ability to create money is reserved for governments alone.
That's absolutely correct. In fact, I did a survey with my students in Frankfurt in 2011. My audience was getting larger when I was teaching at Goethe University Frankfurt. I was only sort of for a few years substitute professor, optional courses. So the first one was only 50 students, but next one was already 150. In the end, it was 450. Everyone was there, also from politics and law. And so I thought, this is a great audience. Listen, guys, let's use these numbers. Let's do a survey. So I sent them out, because if you've got so many people, then if everyone does 10 questionnaires, you're talking big numbers. So we did a survey of Central Frankfurt. And one of the questions asked was just this question. Who do you think creates and allocates the majority of the money supply in the economy? And to make it easier, here's multiple choice answers. The government, the central bank, the financial markets, the banks, and so on. Give a few options. or savings, people through their savings, which is another economic theory. So, and the answer was, just as you said, and you spoke the facts, 84% responded either the government or the central bank are the ones that create and allocate the majority of the money supply. Because that's common sense. It's something very important that clearly affects everything and everyone. It should be in the hands of the government. It's what people feel. But it's not true. That's not how it works. And so what is the answer? Well, of these 3 theories of banking, which one is correct? Well, what's the scientific thing to do? Is to do an empirical test. That's what a scientist would do. But it turns out I was the first to do an empirical test of the 3 theories of banking.
Okay, so I'm curious to get your reaction. Let me just remind you, Jonathan, I know you've looked at the clips. Later, we're going to get into his view of like why, the right way to corral these credit creating banks into doing socially useful things. So if this is the point where you're going to bring up Mises, like, let's not explain what Mises' overall theory of the business cycle is, but just if you want to comment on him explaining that, yes, I was the first person to actually really nail down the fact that banks create money. Can you believe it?
Yeah. So just to recap, I'll play a role that you usually play, just to make sure everybody got that.
Make sure we're not losing anybody. Yeah.
Yeah, that's right. So he's outlined three different views or theories of how fractional reserve banks work, or how money is created through the banking system, if it is at all. And so the first theory he calls the financial intermediation theory. And so this theory, as he sets it up, is that banks are taking in deposits. I guess it doesn't have to be demand deposits. It could be time deposits, savings deposits, and they take in that money from their customers, their depositors, and then other people come into the bank and they're asking for a loan, and the bank evaluates these different people or business projects or mortgages that they could make, and so, but ultimately what they're using to finance those loans are other people's deposits. So the bank is an intermediary. They're between the savers and the borrowers.
Right, yeah.
And
Like the public is saving, giving their funds to the banks, and the banks are just evaluating the creditworthiness, because the banks, that's their job to figure out, this guy might default, let's not give him the money, we'll charge a higher interest rate. But yeah, they're just passing through the savings that are coming from somewhere else. The banks aren't generating that themselves.
Right. So if that's as far as you take it, then there's no money supply growth. It's literally just a transfer of money from one person through the intermediary to the borrower. Now, the second theory that he talks about is he calls it the fractional reserve theory, and this is where he brings up the money multiplier. So once you start with that financial intermediation theory, and then you think about what do the borrowers do with the money after they receive it as a loan. And so they'll spend it, they'll use it to build a house. And so the contractor, the builder of the house, receives the money. And then you think, okay, well, they're going to deposit it in some other bank. And then if they deposit it in some other bank, then now that bank has funds that it can use to, it'll keep a fraction of those deposits in reserve, and then they'll make their own loans. And so that's the step-by-step process. He refers to the money multiplier, where you get these overlapping claims on the same base money, the same money that was originally deposited in the banking system. And through the multiplication of claims on the same money, then you get this increase in the money supply, broadly conceived, including the bank deposits. So that's another theory that he's rejecting. And the one that he claims that he has verified through this empirical test is the credit creation theory, which is that no, it's not deposit first and then a loan. It's actually the bank decides, they just issue demand deposits as a loan to a borrower. So there's no drawdown of reserves. They're not taking money from one account and putting it into another account. They have a borrower come in saying, "Hey, I'd like to borrow to buy a house," for example, and then the bank just credits their checking account with new money. So it didn't come from anywhere else, and so that's why he calls it the credit creation theory. Now, interestingly, like I know you've discussed this in your Understanding Money Mechanics. I don't really think it matters if you change the order from deposit to loan as opposed to loan to deposit, because I think you still get the money multiplier aspect there. You still get people taking the money, and then as they spend it, other people receive the money, they deposit into other banks. Now, what's interesting is that once you think about those consequences of people spending the money that they've borrowed from the bank, even under the credit creation theory, then you see that the original bank has to have expected, or at least they will see, a drawdown of their reserves as people spend it, and then the other banks are saying, "Hey, we've got these claims on your assets," and so the banks have to settle with one another. So yes, if you put on the blinders like what horses wear when they're drawing carriages down streets, if you just look at this original loan contract, it certainly looks like credit creation. But then you have to think about what happens later. Like the money does not just sit in that person's account that was credited with the money in the first place. They're going to spend it. Other banks are going to receive it. There's interbank settlement. So there's going to be a drawdown of reserves. So once you see that drawdown of reserves, then it starts to look like, hey, there's financial intermediation going on, because while the order is reversed, this loan did necessitate a drawdown of reserves. So there was a transfer. And then when you talk about other banks receiving the money, And so they have an increase in the amount of reserves. Suppose that's above their desired reserve ratio. As soon as you take that into account, then you can get the money multiplier. So like my response to all of this is that these three theories aren't mutually exclusive. They're really just describing different aspects of the same story. Some of them are more narrowly looking at one particular aspect, and I think the one that explains it most fully is the one that he's calling the fractional reserve theory, because that talks about all of the knock-on, all of the later effects that or consequences that happen after the loan is made.
Yeah, I love all that. I know at some point we got to work in. We were going to flash a screenshot because you tweeted out in response to this.
Yeah.
So is this a good place to do it?
Yeah, we can do that. So he actually sort of acknowledges this in his paper. He says, see if I can.
Just to be clear, because you didn't just watch the Tucker interview, you actually went and read his paper or one of his papers? Okay.
Yeah. Give me 1 second.
Mississippi. Forgot you're in academia, so for you, time dilates.
Oh, there we go. Okay, so he's talking about how he says the evidence is not as easily interpreted as may have been desired, since in practice it is not possible to stop all other bank transactions that may be initiated by bank customers, in parentheses, who are nowadays able to implement transactions via internet banking even on holidays. So he's saying that we didn't get all of, like, the evidence wasn't as good as we had hoped because there were all of these other transactions going on at the same time while we were observing this bank when the loan happened.
This is his empirical test. This is the write-up of his empirical that everyone's pointing to, like, oh my gosh, for the first time in history, an economist actually tried to test something and see how the world works. Wow. And so he went to a bank and said, I'm going to take a loan from you, and I want us to just document everything going on. And he's saying in that paper, ideally, the bank would have done nothing else except process my loan, and then we could see exactly what the before and after were. But in practice, no, the bank, even though they were working with me and being very nice, they weren't going to stop everything else they were doing. So money's coming and going. All these other transactions are happening overlaid on top of mine. And so it wasn't as clean of a test as one would have hoped for.
Yes, and my point, the quick point that I made on Twitter is that those follow-up transactions are actually critical for understanding how money is created, whether or not you can reject the fractional reserve theory or the financial intermediation theory. Like if you're just looking at the creation of a brand new loan, of course that's going to look like credit creation. But the other theories are talking about, well, what are the other effects of this loan creation? Does the money end up in other banks and then they use it to pyramid and create new loans, and then you get the overlapping claims. And once you take all of that into account, then you can start to see the aspects that are described by the financial intermediation theory and the fractional reserve theory.
Right. Great stuff. So let me try. So folks, we'll probably be snappier in response to the subsequent clips here, but this is the meat and potatoes of what we're trying to accomplish in this episode. So I don't want to breeze through this too quickly. I agree exactly with what you said, Jonathan. Here's how I'll describe it. So we're not losing, folks. Definitely the Mises Rothbard people of the three buckets that Werner just described would be the fractional reserve camp, and that Werner and his disciples or fans would say, you Austrians are living in the past. Don't you understand that old textbook way of explaining stuff is obsolete at this point? All right. So here's how I would explain it, like how I would comment on the three categories he listed. The first one, to say banks act purely as intermediaries where the public saves funds, hands them over to the bank, and the bank just lends it out. And you could say, in principle, wouldn't need banks, right? That if somebody wanted to just, some couple wants to borrow $300,000 to go buy a house, they don't have it, they want to borrow it from somebody, and then 10 separate couples who have $30,000 they want to save each over a 30-year stretch, all chipped in and gave it to that one couple to borrow, that could all work. And you could have 30 separate contracts explaining we're lending you $30,000 at this percent, and you're going to make payments over the next 30 years. And you could go ahead and do that, but of course that would be hard in terms of just the transaction costs for them all to find each other, and it would be extremely risky, right? If you're the saver, one of those that, geez, my money is, if this one couple defaults, then there goes my savings. right? And so instead of doing that, of course, what happens in practice is, there's these thing called banks, and all the savers deposit their funds with the bank or lend their money to the bank, I should say more accurately in this model. And then the bank pools it and lends it out, and everyone kind of just participates in the diversification and pooling. And if some couple defaults on their mortgage, that loss gets spread among everybody, blah, blah, blah. Okay. So if you had what Rothbard in his writings refers to as loan banking, that would be fine. And banks would be pure financial intermediaries where it would just, the only function they would serve is what I just said in terms of like assessing risk better and facilitating the diversification and pooling of the risks and so on. But the banks wouldn't be creating credit beyond what the original savers did. And the households would be restricting their consumption. That's how they come up with $30,000 or whatever I said, because they're consuming less. That frees up resources. And so the economy shifts away from making consumption goods and shifts into other things like building houses and long-term, projects. Okay. And by the way, in that model, if you wanted to have a checking account, in Rothbard's view, if the banks are operating correctly and non-fraudulently, then if you go put $10,000 in your checking account, the bank can't lend any of that out to anybody. If somebody wants to buy a house and say we need a mortgage, they can't tap into that $10,000. No, that's a checking account. That guy still thinks he has that money. So that's if banks obeyed those rules and like it was only CDs or long-term savings accounts and things that they could lend out, then there's no money creation. The banks are pure intermediaries. Okay. All the Austrians would say that is not true empirically. That's not how banks operate, whether you think it's a good or a bad thing. And so that's why they would fall into the second category, the fractional reserve model, which, as the name suggests, means, yes, there's reserves in there that are backing up the checking accounts, but the banks don't keep them all in there. So somebody deposits $1,000, the teller puts the $1,000, into the vault at the night, at the end of the day, and that money doesn't all sit in the bank vault. They end up lending some of that out. And so that's the fractional reserve idea. And then just elaborate where Werner was talking about when he says, yes, there is money creation in this model, but it's like the aggregate outcome of the system. So here's what he means. And I'm just, again, elaborating on what you said there, Jonathan. The way you would teach this in a standard thing, the way textbooks used to treat it, the way I probably taught it in undergrad was, somebody deposits $1,000. Let's just say, to have concrete numbers to work with, the banks keep 10% in reserve. We're just making that number up. There were some regulations in place, but just to keep the math simple. Right? So of the $1,000 that's in there, that guy still thinks he has $1,000 in his checking account. He doesn't think he's loaning money to the bank. He's like, no, the bank is just storing my money for safekeeping and convenience, as far as this guy is concerned. The bank only keeps 100 of that in the vault, takes 900, lends it out to some other guy who wants to borrow $900 for something. Then this story is that guy goes and spends it. Ultimately, the store where he spends it, what does that merchant do with it? They don't just keep it on the premises. They go deposit it in their bank. So from that other bank's point of view, it's like the store just walked up, the employee from the store, with $900 in cash and said, hey, we're depositing this into our business checking account. And so the process repeats, right? Because that store doesn't care about the history of where that 900 come from. They just say, here's 900 new cash in your checking. Well, we're only going to keep 10% of it, right? So they only keep 90 of that there. And then, 810 gets lent out to some other guy. And then, so with each stage, 90% of that original amount gets lent out again in the form of cash, the way this story was conventionally taught in the textbooks and on blackboards, in the 50s through the 80s, let's say. Okay. And so notice when all is said and done, where does that process end? I mean, it's technically an infinite sequence, but in the limit, that original $1,000 now is spread among all the bank vaults in the country or the world economy, serving as the 10% base. And so you say, well, how much in total new checkable deposits could be supported by the $1,000 in currency that is the base? Well, if it's a 10% reserve, then you just times 10. Right, so that means ultimately there's $10,000 worth of checking account balances, backed up by the $1,000 in currency sitting in the vaults spread around the world. Okay, and so the sense, so if you started with $1,000 in physical cash, currency, green pieces of paper, and when the dust settles with all those loans and redeposits, blah blah blah, 10,000 now people are walking around thinking they have that in the bank. Well, that's creation of $9,000 that the banks have, in a sense, created and pyramided on top of that. And the money multiplier is 10 in that example, right? It's like 1 over the the reserve ratio, one divided by 0.1. Okay. So again, I just want to point out, it's a little bit misleading when he's saying, my theory of the banks creating money versus, because even right there, even his own explanation, and when I spelled it out for you exactly what he has in mind, the banks created $9,000. The Fed didn't create that $9,000. It was clearly the commercial banks did. Okay. Then the last one is Werner is saying that the tweak he's making, the way he's saying, no, what we're saying is not the story that door number two was, is he's saying it's not that the first person gives the $1,000 in currency into his checking account, it goes into the vault, and then the bankers take out $900 in cash and give it to the next borrower, and then that guy has to go spend it, and eventually that has to get. He's saying no, the moment. What happens is when the bank grants the loan to that second borrower or the second guy who is a borrower, the act of granting the loan in terms of the accounting and the legality and the mechanics of the banking system, at that moment of decision, $900 has been created ex nihilo in the economy. Whether or not that guy even takes physical possession of the 900 in currency, right? The original 1,000 still sitting in the vault. It was the bank's decision to grant credit that created $900. And so my point is right, and I admit some of the people teaching the standard fractional reserve theory or whatever, they probably didn't realize that, but that is implicit, and that's something that when I started teaching this, like I realized it, and it's like, yeah, that's really, when you're just trying to isolate where is the rabbit getting into the hat for this magic trick, like how do banks create money? That's what it is, right? Because even if the guy takes the money out, and the other guy, he's walking around town now with the 900 in currency, the money supply has already been increased by 900, right? He doesn't have to go spend it and deposit it. It's the fact that the first guy put the 1,000 in, he still thinks he has $1,000. So M1 is still 1,000 from there. People know those monetary goods. And then the bank gives the 900 to the second guy. He now thinks he has 900 in cash balances. He has an IOU. He has a debt to the bank. Don't get me wrong, but a debt doesn't, subtract from the money supply. It's just a separate thing on the side. So that guy thinks he has 900 in cash, whether he keeps it in the bank on deposit. And when you say you have 900, what do you mean? Whether he takes his ATM card and puts it in and says, see, 900, or if he flashes 9 Benjamin Franklins, either way, it's in M1. So I'm just saying, even if you just stopped and you were a total card-carrying fractional reserve banking theorist, I could show you just, thinking through introspection and think that clearly it's the bank's decision to grant the credit that created the 900 there, regardless of whether the guy, took the money out physically or left it with the bank. And then the last thing I'll say here, Jonathan, is I liked how you put it in your tweet that, so if it seems like, well, what's the difference? Aren't we saying the same thing? Well, no, I still think the fractional reserve story is more accurate and better to teach people, because the banks, if all you knew were, banks can just create money, you know what I mean? Like you think it's the central bank or the government. No, banks just create money by the mere act of granting loan. Then it's wonder, like, how come the banks aren't all trillionaires, the bankers? And the reason is, like you're saying, because they have to be careful. They can't just grant, loans to themselves and then go buy yachts and things, because there's the reserves. That the way the interbank clearing system works is if one bank expands too rapidly and grants too much credit, and its customers are going around spending money, then the other banks get piling up claims on that first expansionary bank, and it loses its reserves just in the interbank clearing process. So when you understand how all that works and why there's limits on what the banks can do, and Werner in the Tucker interview alludes to that. He said stuff like, no, they got to be careful and blah, blah, blah. But when you spell out, well, why do they have to be careful? It's because, the fractional reserve people, you got to go read their writings to understand. And like somebody like a George Selgin or Larry White in their free banking model, they go ahead and model it. They think it's cool. Rothbard would say it's not cool, but we all agree just because banks legally can engage in fractional reserves doesn't mean they can just make loans to each other and go buy yachts and say, hey, we can just create money, ha, ha, ha. You know what I mean? So anyway, I know that took a while, folks, and I promise we'll be snappier going forward in this episode, but I really wanted to just nail down, I think this is critical, that when people are like, you fractional reserve theorists have been disproven, it's because if you're just ignoring what happens after the bank grants the loan, then you can forget about reserve. But no, reserves are important whether or not they're legally required. Okay, I know I went on a long tangent there, Jonathan. Anything you want to say before we move on?
Yeah, I'll do it very quickly. Mm-hmm. I don't want people to think that we're just like, sitting in our armchair like we've been presented with this empirical evidence from Werner, and it's like, well, no, if you think about it, it must be like this. I know it sort of looks like that because we're sitting in chairs and we're just like thinking through. But
I'm in a kneeling chair, if that matters. But
I just want to point out that if you look at Werner's paper, he says the evidence is not as easily interpreted as may have been desired, and the point that he's making there is there were all of these other transactions that were conflating, they were muddling. And what we're saying is that, yes, those other transactions are an important part of the story. So like you have to think through or be an empiricist, look at what happens after this initial act of credit creation. And then once you do that, you see that what he's calling the fractional reserve theory actually does a better job of explaining the story in a full way.
Oh, I thought of another way to put it. Carlos Lara, actually, a guy I've co-authored some books with and done some projects with in the past. But when I first encountered him, he was actually he was using Rothbard's, I don't know if it was Man Economy. He was using something from Rothbard. He must have been Man Economy mistake because Carlos was using my study guide. That's how he reached out to me because we both lived in Nashville at the time. So anyway, he was doing a PowerPoint presentation around circa 2008, right when stuff was blowing up, explaining to conventional bankers around Nashville. He was giving these PowerPoint presentations explaining how fractional reserve banking worked. And it was blowing their minds. They would come up to him afterwards and say, we had no idea we were doing that. And so, and the way Carlos put it was great. It ended up being this book that we wrote called How Privatized Banking Really Works. But he said, like, so back at that time, this was the Fed still imposed reserve ratio requirements on the banks. And so we just rounded it to 10%. It was more subtle and nuanced, but he was just saying, for the sake of argument, say it's a 10% reserve ratio. And so he was saying, I'm just going to adapt the numbers we've been using here, Jonathan. Strictly speaking, yeah, Jim Smith walks into his bank and gives 10 Benjamin Franklins over to the teller, says, I'm depositing $1,000 in cash into my checking account, and walks out. The 10% reserve requirement, if that's what we assume, is legally imposed, the bank would have the legal ability to go make a loan of $9,000 to somebody else, so long as they thought that person would just leave it sitting in his checking account and never spend a penny of it, right? Because then that guy's $9,000 in checking plus Jim Smith's $1,000 would be $10,000 in checking accounts. And they'd say, what's in the vault right now? Oh, $1,000 in currency, 10% satisfied. But Carlos went on to say, but that would be ludicrous for them to give that much at that stage, because if that other guy spends any of that $9,000 that they just granted to him, well, then in the interbank clearing process, they're going to get hit on the $1,000. They're going to have to transfer that to another bank, in terms of the money will go out of their vault over to the other bank's vault or on deposit with the Fed. They'll debit their reserve account with the Fed and credit the other bank's reserve account with the Fed. And so then, when the dust settles, they will no longer be in compliance with the legal reserve requirement. So that's where it comes in these FRB, examples that you had to learn when you took Econ 201 or something and then it lends out 90%, and then they do this and lends out 90%, that's how the bank can be sure, even if this guy goes and spends it all right away, we don't get caught with our pants down. Like, that's why it had to be the step-by-step thing. But yeah, Carlos recognized in terms of just the principles and the reserve requirement, yeah, right out of the chute, you could lend the full amount if you wanted to, but it would just be reckless to do it because, like you're saying, Jonathan, once the other transactions start kicking in. So again, and Carlos was, full-blooded card-carrying fractional reserve banking in the Roth, theorist in the Rothbardian tradition there. He was just exculpating what he's found in Rothbard. Let me just, in fairness to Werner, though, he did say at the start of that clip that, economists don't have banks in their model. What the heck? He is right that a lot of macro economists in the mainstream don't. So Scott Sumner, who's like the Mercatus Institute's go-to guy on, money and banking and the Great Depression and what caused the Great Recession and everything, he proudly says, I don't have banks in my model, because he says, you don't need it, right? Like, in other words, I'm above the fray. I'm the person who's really isolated. It's NGDP growth, period. And, you don't need banks. So Werner's not attacking a straw man there, but I know maybe now, Jonathan's where we can flash it. It is not true that the Austrian school doesn't have banks in their model, is it?
That's correct. So yeah, that was another thing. Probably the first thing that I responded to publicly after this interview is I just showed that So I paraphrased Werner saying economists ignore banking. And then I showed the table of contents from Mises's 1912 book, The Theory of Money and Credit, originally published in German. And actually in Werner's History of Thought paper, he cites The Theory of Money and Credit. And he also cites Hoppe, Holzman, and Bloch, their 1998 paper against fiduciary media. So Werner has been exposed to the Austrian school and has read at least parts of Mises because he quotes Mises in that paper. But I just showed that table of contents just so, Mises was on this as far back as 1912, and he showed how fiduciary media works, what fractional reserve banking does and means, and what are the consequences. I'm sure we'll get to Austrian business cycle theory at some point in this episode. But yeah, so I was just showing, and it wasn't just like back then. It's not like Austrians have forgotten about what Mises wrote about. Like, this has been a part of our tradition for over 100 years. So yeah, that critique applies to the mainstream, but definitely not to the Austrians.
Okay, well, that's good. So I need to go read his thing. I probably looked at it years ago when somebody first, threw Werner in my face and said, haha. Okay, so that's what I was going to say. I was going to give him an escape hatch, because he does say, even in that Tucker clip that we played, he's not claiming he invented credit creation theory circa 1989. He's saying this used to be known and then was buried by the CIA or whoever, and then now has come back because he resurrected it. So I guess you could say, in fairness, maybe he would say, oh, yeah, Mises knew about it. And I'm just saying nowadays that's been completely lost. And you could just say, well, don't you know about the Mises Institute? But okay, fair enough. So maybe I'm bristling too much to the guy. Okay, I have been burning too much time here. Let's go, folks. Let's get clip number 2 ready. Go ahead and let's play clip number 2.
Basically, the Bank of England was alchemy at work. You're creating money out of nothing, but not through the actual physical alchemy process. It is the credit creation alchemy. Because banks create money out of nothing, but it's a trick. So what happened is this: when gold is money, and people think we need gold for transactions. One thing was the government's investing in, creating gold, but that was of limited success. Now the reality is, though, that people don't want for their transactions to carry gold around, because it's dangerous. I mean, even today, if you go around New York City, Manhattan, you don't really want to walk around with too much visible gold hanging around you. That's right. It's kind of, in London, you wouldn't want to do it. And that's 21st century. So imagine, 15th, 16th century, 17th century, you don't really want to do that.
Bandits on the roads. No, not a good idea.
So what do? Well, you put your money, your gold, where it's safe. Turns out there's some professions that were working with gold, and therefore they had safe places. They had their own little private security team, private army to watch their safe with the gold. And these are the goldsmiths. They make gold jewelry for the king and the aristocrats and the rich people. And so people started to deposit their gold with the goldsmith. Obviously, you need evidence. Like, what if something happens to the goldsmith and his son taking over the business denies that that's your gold? So clearly you need some receipt. Okay, so that was the convention. They got a little fee for safeguarding the gold. Fine, everyone's happy. But the next step is this. Let's say I'm, in the province, somewhere in Hampshire, in England, and we're neighbors, and we agree I'm buying this plot of land from you, and we agree on the price and, okay, how much gold? Fine. So what are we going to do next? Well, I've got the gold with a goldsmith in London. Okay, I will go and get the gold. By the way, what are you going to do with the gold? Because if you're not going to keep it here, then it's kind of dangerous. Like, I'm risking my life going to get the gold, bring it here, and then you bring it back to the goldsmith. We might as well leave it in the goldsmith, and I give you my deposit receipt. And that's what happens. So the receipts of deposited gold, of deposited money, became the first paper money in Europe.
Gold certificates.
Yes. Exactly. That's how it works. Now, so the goldsmiths, of course, realized what's happening. Oh, nobody's coming to pick up the gold. That's kind of convenient. And this already explains the secrecy that suddenly then engulfed the whole thing. Because people also realize, well, the goldsmiths have the money, they have the gold. And if you get into trouble or you lose your job, you need money. Where do you go? Well, the goldsmiths have money. So people came there begging for money and asking for loans. Here's where the secrecy comes in. Until around 300 50 years ago, in almost all European countries, it was illegal to lend at interest.
Of course.
That's
Christianity.
Christian rules. The Bible was against interest, and interest was everywhere forbidden. So the goldsmiths would say, oh, well, yeah, maybe I can lend you some money, but we have to keep this very secret. Because, of course I'm going to charge you interest. Yeah, I'll pay interest. Yeah, we'll keep it secret. And this is what happened. The goldsmiths then realized next, well, hang on, maybe we don't even need to lend the gold. And of course, like every guild, any trade association, they were meeting regularly, they were talking shop. And, how do we deal with this issue? Of course, we don't want to lend out too much gold. We might get into trouble. Also, we need to collaborate. If some goldsmith suddenly needs more gold, we have to help each other. Otherwise, everything will come up and we'll all get arrested for lending at interest. So they were sworn to secrecy. And one goldsmith, probably the first one to have this idea, said, well, hang on, guys, I've got an idea. We don't need to lend out gold. I'll show you. So there's always this guy coming every Monday morning. Okay, so let's wait. He's coming probably in 20 minutes. They always want to borrow money. I've turned him down. I'll lend him money to show you. So he comes around. Oh, please. Oh, dear goldsmith, I need to borrow this money. All right, today I've decided I'll lend it to you. Here's the standard contract, all the small print, the interest. Your daughters will be sold into slavery if you can't repay. It's just standard practice and all that. Small print. Don't worry about it. Yeah, I know. Okay, it's fine. Just one more thing. Before I give you the gold, okay, we said 300 grams of gold. Here it is. I will, you sign there, I sign, and I lend it to you. But I want you to deposit the gold immediately with me. Well, I need the gold. I need the money. Yeah, but you get the deposit receipt and, oh, yes, of course. Yeah, that's all I need. I need the receipt. Get it? So what happened was the goldsmith, loan contract signed, and the goldsmith buying that loan contract, that's an asset on the balance sheet, hands out the 300 grams of gold. Now you see it, now you don't. You've deposited it. Here's your deposit receipt. It's all very transparent, and with double entry accounting, which was created for banking, to hide the truth of banking, it looks all very transparent because you can't see the money creation at first sight in double entry accounting. So why is it's all correct? The borrower deposited the money. Didn't you see it? Just deposited it. But it is still fraudulent. It's fraud. And you can prove this because did this person, the borrower, when they walked to the goldsmith, did they have gold with them? No. But they're leaving the goldsmith with a document that confirms they've deposited gold. Well, how did that happen? And also, secondly, if you measure the amount of gold at the goldsmith, did that increase? No. So that's fraud.
Okay, Jonathan, I have some stuff to say, but do you want to go first?
No, I went first last time. I'll let you take the lead on this one.
Okay. So here, obviously people, Rothbardians watching, but yeah. But let me, again, push back on this notion that this is, guys, come here. This is a secret that they don't want you to know about. The CIA buried this. Okay, watch this, folks. I'm going to show you some screenshots here. Okay, this is from a book called Modern Money Mechanics, not to be confused with Modern Monetary Theory. This is Modern Money Mechanics, a workbook on bank reserves and deposit expansion put out by the Federal Reserve Bank of Chicago. Now, when I end up showing you what they're going to talk about, you might think, the Fed was formed in 1913. This must be from like 1916 or something, because Werner, in this Tucker interview explained how this was all quashed and nobody knew about this. This was forgotten 100 years ago, ancient wisdom that he resurrected in like 1991. But no, this book that I'm, about to quote from originally came out in 1961, right? And then it had subsequent, updates and whatever in 92 and so forth, right? So this is something that originally the Federal Reserve Bank of Chicago plugged into, the New World Order or whatever, published in 1961, and then there were multiple updates, okay? And now let me just show you, with all that build-up, you said, wow, this better be good. Oh, it will be. Okay, so early on, this is like page, this is like page 4 or 5 or something in this workbook, and the section's called Who Creates Money? And it starts out, changes in the quantity of money may originate with the actions of the Federal Reserve System. People are falling asleep. Yeah, that's what we think the government and the central bank are control. But then you skip down 4 paragraphs. It started with goldsmiths. As early bankers, they initially provided safekeeping services, making a profit from vault storage fees for gold and coins deposited with them. People would redeem their deposit receipts whenever they needed gold or coins to purchase something and physically take the gold or coins to the seller, who in turn would deposit them for safekeeping, often with the same banker. Everyone soon found it was a lot easier simply to use the deposit receipts directly as a means of payment. These receipts, which became known as notes, were acceptable as money since whoever held them could go to the banker and exchange them for metallic money. And then what I've highlighted, then bankers discovered that they could make loans merely by giving the promises to pay, or banknotes, to borrowers. In this way, banks began to create money. Okay, folks, so that is from the Federal Reserve Bank of Chicago in 1961 in a workbook for the public. As far as I know, I mean, the thing I'm just reading for is a PDF that's online. I don't think this was just an internal thing that they're saying, let's make sure the rubes don't get a hold of this. This is what we've been doing, right? So this is, again, so I'm trying to convey, I'm trying to be cheeky about it too, but what I'm trying to convey, folks, is a lot of what Werner was saying in there is, good stuff, and I'm glad that the word's getting out, but his constant refrain of, he even went so far, folks, in one part, we don't have it in the clips here, is to say someone from the CIA or someone from the U.S. government told him the CIA is watching you, okay? I don't know whether that person was claiming to be from the CIA himself. In terms of, you got to stop telling everybody about how banks work and how they create money through credit creation and stuff by the mere act of granting loans, right? So I'm saying right there, it's not just saying banks create money, but they even went through the whole story of the goldsmiths and what happened step by step. The thing he just told Tucker, and Tucker's mind is getting blown. The Federal Reserve Bank of Chicago published that in 1961. Okay, Jonathan, go ahead.
Oh, no, yeah, I completely agree. I mean, this sort of story you can see in Rothbard's writings when he's talking about the history of money and banking. Mm-hmm. And so, like, this is not something that's like some brand new, shock and awe sort of discovery on the part of Werner. This idea that banks can create money through their fractional reserve, deposit and lending operations. There's an increase in the money supply. I know we were just talking about the three different theories, and there's some quibbles about which one is the most accurate description of what's going on. But like the idea that banks are creating money, and that this originated with the actions of the goldsmith bankers, it's like this is. I guess I can't say it's common knowledge, but among economists, especially the economists that I work with and talk with, it's common knowledge. So this is not some sort of like earth-shattering thing. And I also think that it's doubtful that the CIA is coming after him because he's revealing this. Because as you mentioned, there are Federal Reserve documents that are explaining this same history. So like if the CIA is against Werner, then the CIA is also against the Federal Reserve. Now that would be a movie that I would like to see, is like some fighting between
what
the
next?
CIA
The CIA against the sitting president in the 1960s? I think not. And also just to clarify, you're right, John. I don't mean folks to say, oh yeah, you would have to go to this 1960s. This is just chock. Rothbard and Mises' writings are replete with this stuff. But given that we earlier gave a nod to maybe what Werner has in mind is, oh yes, these obscure, marginalized Austrians who don't have any prominent academic posts anymore. They're just a chapter of the history of. They still talk about this stuff, but I'm talking to show that he can't merely be saying that. Is I'm saying Federal Reserve Bank itself explained all of this and gave that same goldsmith history back in 1961 and has published multiple updates of that document throughout the decades. Okay, so again, I'm just, the reason I picked them and not, something from Rothbard's What Has Government Done to Our Money or something, is to show this is not some heterodox, obscure thing that only, post-Keynesians and Austrians know about. Okay, we're going to get ready to play clip 3 here, folks. Let me just set this up a little bit. So Jonathan, this is the one that's going to be a surprise for you. I was intrigued by what Werner just said there when he's telling the goldsmith story and how the bookkeeping worked. And so it is kind of neat, right? When you're really trying to understand, he was trying to isolate the fraud involved and how something screwy is going on. And again, just folks to explain, to paraphrase what his story to Tucker there was, some original people deposit actual physical gold, back in the days when gold coins were the money. And the bankers give them notes, saying, we acknowledge you deposited this amount of weight of gold into our vaults, and at any time this note allows you to redeem it. And so that person can now go around town spending those notes as being the same thing as money, because the merchants realize, oh yeah, if I wanted the gold coin, I would just go down to the goldsmith and hand this note. Okay. But then now that the goldsmith has a lot of metal, yellow metal sitting in his vault, somebody needs to borrow money, and he goes ahead and does the transaction and says, here, technically, let me take the gold out, give you a bag of coins, you're signing the IOU, blah, 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 or I'm going to charge you, 16% interest per annum, blah, 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 blah. And now, you know what, as part of the deal, give me that bag of coins back. I'm going to go put it back in the vault and close the door. And here's the note, right? And so he's saying in terms of the double entry bookkeeping, it all looks, above board and everything, but it's, there's obviously something's crazy going. That guy's walking around back into town now with notes saying, I just deposited these gold coins when he didn't start out with them. So something's fishy, right? So Jonathan, I went and dug up, I found an old video on YouTube from more than 10 years ago of, I think it's Werner, I'm not sure, but there in the example he goes through is talking about gold coins and deposits, and he goes through step by step with the bookkeeping involved in terms of the double entry bookkeeping, how this, thing works. And one of the examples, it's like it starts out, original guy deposits, I think it's 100 ounces of gold. And then this guy Guido shows up and borrows 90. So I'm assuming, because Guido's kind of a weird name, that this must be Werner. That's the only explanation I can find. He looks a little different, but again, this video that I found was from a while ago. So folks, just to pace yourself mentally, this is a 4-minute clip. Let's go ahead and play clip 3 of how what Werner just said there, sort of intuitively to Tucker, was unpacked in terms of the actual accounting and bookkeeping.
So what I'm saying in this slide here, look at this carefully. There's still 100 ounces of gold in the vault, and the bankers are still counting that as assets. And now, on top of that, the bankers are counting the 90-ounce IOU from Guido as an asset, too. Because in their mind, they're saying, no, this is a legally binding contract he just signed with us, and he's a smart guy. He's going to come up with the money. Even if that weird book he's writing doesn't pan out, he's probably going to just go shake somebody down for it, so we're going to get paid. So this is clearly an asset. And we still have the 100 ounces in the vault. And the way these fractional reserve bankers work, they think money in the vault is our money. We can, that's our asset. So the asset side is 190. So we know, because of the double entry bookkeeping, it's got to be the case that the liabilities and shareholder equity have to equal 190. And so where does that come in? Well, right now there's still no equity. Okay, because nothing is, all the bank has done is made a loan. That per se doesn't earn them income. They earn income over time through interest accrual. So right now, at the moment of giving that loan to Guido, they haven't earned anything. So where that 190 comes from on the right-hand side is the fact that Billy still thinks the bank, that he has a claim on the bank of 100 ounces of gold. And at any time he wants to, he can either write checks or he can show up and withdraw his money. So when the bank, legally speaking, wants to say, what are our liabilities? Well, Billy has the right to withdraw 100 ounces of gold, but so does Guido. Okay? So it's true, Guido didn't walk out of the bank. He didn't want to walk out with 90 ounces in metal, but he could have if he wanted to. And now with his checking account, if he wants to, he can go to a bank and write it out to cash. If you've ever done that, if you write a check out to cash and give it to the bank, they give you cash for it. Okay, so he can do that if he wants. It's just he doesn't want to do that right now. And in any event, if he writes checks to merchants in the community, then this bank is going to be obligated, if the people who get those checks want, to hand over physical gold. Okay, so now the assets and liabilities are 190 ounces. So when we talk about, so notice what happened here is the bank's balance sheet expanded or grew because of granting the loan to Guido. And that's why I did it this way. I didn't want, because probably most of you, when you hear examples like this, you're thinking, okay, first there's 100 ounces in the vault, and then they took out 90 and gave it to Guido, and he walked away. But what I'm trying to isolate and show you is, no, the first thing that happens conceptually in terms of the accounting is the mere granting of a loan to Guido all of a sudden increases both sides of the balance sheet. And to the extent that Guido may not withdraw the money, then at that point in time, in that period, the money supply or the money stock in this community is now bigger. And what do I mean? Well, I'm saying to the extent that we consider checking account balances or demand deposit balances part of the money supply or the money stock, clearly it's gone up by 90 ounces. So if Billy is the only person in the community originally, it's gone up by 90%. Now, of course, there's a lot other money in the economy, so it hasn't gone up very much. But you get the idea. Okay, so this is the sense in which fractional reserve banking increases the money supply, at least depending on how you define it. So obviously, it hasn't increased the amount of physical gold, what we would call reserves, but it has increased M1. All right, and later on in the course, we'll define what's the difference between monetary base, reserves, M1, M2, that kind of thing. But I'm saying this is what Rothbard has in mind when he says fractional reserve banking can increase the money supply.
Did you get a call from the CIA after that?
No, I didn't. So, of course, folks, what that was is an excerpt from, I had done a course on how the Federal Reserve works for the Mises Institute, which, I meant to verify. I think they rebooted those. I think that's actually still, I think you can still get it. I'll check. But by the time you're seeing this, folks, we'll put a link in if that's a thing, if you can go watch it. But any event, that is, we gave like a sample, right? So that particular lecture they pulled and they posted on YouTube, and that's got like 19,000 views or something. And I just go through it. So the context there is that was the third one. I originally went through the bookkeeping of just standard loan banking, like to show if they really were just financial intermediaries, how's that work? And also what I do, folks, is I show how does the banker, earn income over time so they do increase their equity, right? So there's a way that the banks profit from this practice, but the point is they can't just give loans to themselves because you don't earn income from the granting of a loan. It's got to be over time. It's the interest income. Okay. So obviously my point there, folks, was to say, you notice how there's a lot of similarity between what I just went through there and what Werner's telling Tucker. Psst, come here, let me tell you what they don't want you to know. I'm the first person to really blow the lid open on this. I mean, so you can see maybe why some of us are like, come on, dude. All right. Anything else you want to say, Jonathan, besides noting the amount of sunlight that was, or overhead light that was bouncing off my head there?
I did notice that, but I wasn't going to call attention to it. But I mean, another funny thing that's happened is that while I guess the CIA didn't call you after this video, what do you think there was any sort of like implicit message in the WEF highlighting your book, Understanding Money Mechanics? It's like, hey, we're watching you, that sort of thing.
I don't think so. So, folks, what he's talking about is my most recent, what I'll put in a note in the show notes page too. For the Institute, I wrote this book called Understanding Money Mechanics. And, of course, we go through all this stuff in that book as well. And the World Economic Forum, the Klaus Schwab thing before he stepped down, that was all the rage. You will own nothing and be happy. We'll make you eat the bugs and all that stuff. When they were coming out, and they had like a quick video on their YouTube page explaining like, oh, new books to check out, and they were going through it, and one of them was mine, highlighting it. And so of course a ton of people were sending that to me, either laughing and thinking that was hilarious, or wondering like, Bob, what's your deal? Like, how come the WF is pushing your book? I don't know what to tell. I mean, so I don't have any inside story. Obviously, if I were working for them, I wouldn't tell you guys. But my guess is, Jonathan, it was just some like low-level staffer that just thought, oh no, this guy does a good job explaining stuff, and our people want to know how banks work, and so there you go. So that's my innocuous explanation. Okay, folks,
you haven't seen like black Ford Explorers or black trucks and helicopters flying over.
I guess what I could do is just every bad thing that has happened and why I'm not as popular and I'm not yet the multimillionaire that I think I really ought to be given my talents. It's because behind the scenes, the CIA has just been, blocking me and doing all sorts of stuff. Okay. We got one more clip for you folks. Clip number 4, please, Mr. Engineer, and we will then discuss and wrap this thing up.
In principle, banks get their return from the difference between the interest they pay on deposits and the interest they earn on their lending. But the key thing is that for the actual lending, they're not really giving up intrinsic resources because they're creating new money. So it's actually easy for them to earn this
all
money.
fake.
But it is, there's technicalities and you have to do it properly. It doesn't mean, you can be careless. And sometimes when they are careless, it blows up and we have banking problems, and banking crises. But the regular banking crises are mainly when banks create credit for asset purchases. And that's what creates these boom-bust cycles. In the UK, bank credit, 85% of bank credit is for asset purchases. And so you get these asset boom bust cycles, banking crises in regular intervals. In some other countries, I haven't mentioned the third scenario now. So bank credit for asset purchases, no good. It's not sustainable. It's not productive. Credit creation for consumption it's for the real economy, but it's for consumption. Therefore, it's inflationary. It's also no good. It's not sustainable. The third possibility is the redeeming feature of banking. And that's why we can turn banking into a very positive, very powerful positive force for creating prosperity and abundance. Namely, when banks create credit for productive business investment, for the investment in the production of goods and services, implementing new technologies, implementing new ideas. It's actually the driving factor for growth and prosperity when banking supports entrepreneurs that implement new things. And that's when you get very high economic growth without inflation, without asset inflation. And so really what we should do is bank credit creation should be mainly only for business investment. But this is not what regulators do. Regulators now have not just hundreds, they have thousands of rules for banks. And banking is the most regulated industry on the planet. Most of them are useless. They don't achieve the goal of preventing banking crises. For that, we can scrap all these rules. We just need one rule, that banks should only be allowed to create credit if it contributes to national income through business investment.
So as long as the fraud is done in a socially approved way that helps everybody, then it's fine.
Yeah. So this is where I was thinking, I wish he had read more of Mises's theory of money and credit. Although I'm not sure like how obvious it is. Like if you just do like a first read, do you really get all the ins and outs of Austrian business cycle theory? But what he's describing there, but by the way, I agree with him about, bank regulations. Sometimes they're onerous. Sometimes that leads to like less productive lending. So there's a lot of agreement there. But then when he comes down to this prescription that we should restrict banks and say that they can only make loans for business investment, it's got to be this, profitable, productive, encouraging employment, stimulating national income, these sorts of things. Like he's basically just described what Mises pointed out as what starts the business cycle. So I guess he's sort of thrown out this interest rate issue. And in fact, elsewhere in the interview, he just sort of like disregards interest rates.
But he sort of mocks it, like, that's another red herring that, a lot of the mainstream is going to tell you that interest rates have something to do with credit flows. No, they don't.
But the idea is that when the bank is increasing the supply of loans to businesses, so let's just like think through what happens if we adopt his prescription. When the bank increases the supply of money, increases the supply of credit, and offers it to banks, that pushes down the interest rate. That increases the supply of loanable funds. If you just think about the typical Garrisonian graphs, increases the supply, interest rate comes down. And now, what does this do to entrepreneurs? Like, what do entrepreneurs see? What do they think? How do they respond to this? And the answer is they take the funds because they're cheaper. There's more funds available. They take these funds and they start new lines of production. They buy new capital goods. They make new capital goods. And what Mises pointed out is that when they're doing this, they're not just increasing productivity. So it sounds like, new capital goods, that increases productivity, starting new lines of production. This is good for employment. This is good for national income. But what Mises pointed out is they're making specific capital goods. And the sorts of lines of production that they're starting are ones that are longer than we can actually finish. So there's a certain amount of saved resources. There's a certain amount of capital that we have available to us. Yes, we can move things around. We can start to make different capital goods. We can start these new longer lines of production. But ultimately, the real resources aren't there to actually complete these projects. And so you get into the middle of them and you find that the capital is more scarce. And I mean like physical capital goods, like the capital goods that you need to finish these projects just doesn't exist. So their prices increase. These new lines of production that appeared profitable now they realize that they will not be profitable, so they abandon the projects, they liquidate, they lay off their workers, and we have this crisis, we have this bust or the recession period where we need to correct those mistakes. So the very thing that he's prescribing is what Mises cautioned against. He said, no, we can't do this. By the way, I completely agree with him. You can have, bank credit expansion that turns into like this big asset bubble, or it can cause, like a simple inflation if it just goes to consumer loans and they run up, credit card debt as a response. But the specific channel that Mises explained is what results in a business cycle where we have these big macroeconomic swings is when that credit creation, the money creation is channeled through credit markets to business investment, and they start these projects that can't be completed. So here he just needs to do his homework. He needs to finish The Theory of Money and Credit. I know he's read at least parts of it, and think through all of the consequences of allowing banks to do this sort of thing.
Yeah, great stuff. I'll just be real quick here and we'll wrap up, folks. Just to elaborate a bit on what you said there, Werner, one of the things he's known for is he has this idea of disaggregating the credit flows and to distinguish between our banks, this new credit they're creating, is it fueling asset purchases or is it like going to households and they're using it to buy gasoline and tuna fish? And so to understand what type of credit inflation is going to cause what the public thinks of as inflation, meaning like, oh, gee, I go to the grocery store and stuff's more expensive. You need to know where's the new credit flowing. And so I think that's a good contribution that he made, or a good distinction he's drawing. And it does help to explain, you told me before, Jonathan, I need to stop apologizing for it, but some of us worried about the rounds of QE and we're thinking, oh, that's going to, that's going to cause consumers to see higher price inflation at the store. And it didn't. And so, yes, that looking more carefully at the flows and things, because in other words, QE did cause prices to go up, but it caused like the price of mortgage-backed securities and the price of treasuries and the price of, stocks in the S&P 500 to go up. It didn't cause tuna fish to, go up by 5 times. So there's that element. And I think, he does a good job. We don't have the clips here, but when he's talking to Tucker about that and doing the MV equals PY stuff, and that's where he gets into all that, and the failure of standard monetarism. And, Milton Friedman was lamenting in the early 80s, like, oh, geez, V is unpredictable and it kind of screws up my model as a quantity monetary theorist or monetarist. Okay, so that's all good stuff. But yeah, on this thing right here and elsewhere, he talks about too, like, oh, yes, we want the public authorities to be control of the money. And that's what, and again, for all the reasons you don't want the backroom bankers with their cigar-filled rooms making deals and fraudulently creating money that doesn't exist and lending it out to the wrong people. For all those reasons, you also don't want them, quote, lending to the right people either. That in the standard, in the Rothbardian sense, even though Rothbard understands the credit creation and money creation dynamics, he thinks that's fraudulent, just like it seemed 10 minutes ago Werner agreed. And so if something is fraudulent, you should probably stop it, right? You don't need systematic fraud for a healthy economy. And so if banks merely acted as credit intermediaries where households genuinely saved, that would free up real resources that aren't being devoted to producing consumption goods and can shift then into investment goods. That's how it's all internally consistent and sustainable. So in Werner's frame, his last point I'll make here, folks, is, yeah, you've got all these local community banks or whatever spread around the country. This is, I don't have it in the clips, but that's what he's telling Tucker. The right thing to do is when Deng Xiaoping went to Japan and they gave him the secret to sustainable high economic growth over the decades. It's, oh, you don't have all the power of credit creation vested in the one Bank of China. You got to distribute it to the local banks and have, them making loans because they got their feet on the ground and they, can give it to the local hardware store that nobody's heard of, but that's what you need for, sustainable. But how is the local hardware store getting the lumber to build the building and getting all the tools and everything if households haven't genuinely cut back on their consumption, right? That there's physical processes involved. It's not merely bookkeeping operations. And so that's what is the genius of Mises and his theory of the credit cycle, is that he realized that, yes, he, back in 1912, he explained how banks create money through the act of granting loans over and above their reserves, the way, Werner said was known. But then Mises explained, and that's what causes the business cycle per se. There's no way to do it in a healthy manner. That process per se causes the boom-bust cycle. And, and that's what it seems like Werner did not quite get to that part of the lesson. Okay, I'm done. Jonathan, do you have any parting words for the audience?
Yeah, one last thing that I'll say about this. So he talks about the asset price inflation if banks are lending and people are just using it to bid up, real estate, stock prices, and so on. And he talks about the consumption that just causes inflation. But the main case study that he's looked at is the Japanese experience. And so what if the problem is bank lending that's being used to bid up asset prices, or bank lending that's just being used for consumption, then the correction to those problems it's just a nominal problem. So for an asset price inflation, suppose it's a bubble, like a speculative bubble, then the correction that needs to happen is just new prices. But people just discovered the new prices that reflect actual productivity or the actual value of the underlying assets. In the case of consumption, it's there's a new higher level of prices, and people, obviously that's unpopular, people don't like that, but it's just this nominal increase in prices of consumer goods. But if you see in cases like the Great Depression or the Great Recession in the US, or even the Japanese experience where they had this long recession, it means that there's some real problem. And I mean real in the economic sense. There's
as
something,
opposed to monetary.
Yeah. It's not just a nominal problem. It's not something that could be fixed by just people changing prices. It's not something that just results in a price change. But there's actual real resources that are misallocated. There's labor that had been used in an unproductive way, and now people are unemployed and they're trying to find a productive and profitable way for them to be employed. So you actually have to move scarce real resources around. And if that's the case, then the problem is not that banks were lending and that lending caused asset prices to increase, or that banks were lending and people were just using it for consumption, because those problems are fixed, or the consequences of them is just change in prices, just nominal fix. It means that the problem is actually a real one, and the one that the answer, the solution to this is, you need an explanation for the real changes in production and capital employment and labor employment that happens when businesses take those loans, and then they come up with a new structure of production. So it seems to me like there's a big gaping hole in his framework, and that gaping hole is he's missing Austrian business cycle theory.
Right. Just one last comment on that to emphasize what you're saying. I forget who said this, but I think it really helped me when I was trying to understand and distill down the Austrian theory and compare it to the other schools of thought. Is someone said, people often read Mises and Hayek and think it's a theory of overinvestment causing the business cycle. And they said, no, it's a theory of malinvestment, M-A-L investment. And that's critical, right? So it's not just people invested too much. No, because if it's just they invested too much, then that just means, we had less consumption than we would have wanted to in an optimal time path, blah, blah, blah. But okay, fine. We end up next year with more tools and equipment than we would have planned on. But now that we have them, great, we're that much more productive. But no, it's what if you made a bunch of hammers, but they didn't make any nails? And then next year, now we've got thousands and thousands of extra hammers, but no nails. And that, so I'm exaggerating, but that's the Misesian story. And you can see you don't fix that just by saying, let's just change the price tags. No, there's going to be real consequences if that's what's happened physically in the structure of production. And banks lending out more than they have in reserves is what fuels that in the Misesian story. Okay, well, thanks, Jonathan. I think we did the best we could be expected to in terms of unpacking the good and the bad and the ugly from Richard Werner's recent appearance on the Tucker Carlson show. I want to thank you for showing up and giving your insights.
Yeah, thanks for having me. It's been great.
Thanks, everybody, for tuning in. We'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.